simple quote.
We're
That's why it's
live on
gotta be
Oz
the
Property
site.
Investors. We bring the big name. The big fun. We're having so much fun. We just had to hit the go live button. So how you going, Tony?
Yeah, very, very well. Thank you. Yeah, awesome.
Yeah. Good to hear. Sorry, I thought otherwise it was going to delete us. We're running late again. How you going anyway, Joe? What's been happening, mate?
I'm good, mate. I'm excited for this one. Accounting is often called the boring subject, and people don't really get along with it too much at times. So I'm excited to unpack, because Tony's very good at breaking down the complex and making it simple to understand, and the reasons behind why have we got all these things. What is a trust? What is a company? What is a corporate trustee? How do these things work and interact, and actually make it pretty easy. But Jeff, how are you, mate?
Yeah, I'm really feeling really good, actually. Just loving life and getting into got a bank holiday got a holiday next Monday, so head down here in New South Wales. Happy days, but excited for this session. And if you're interested, if you want to ask a question, please drop in the comments. We are going to make this interactive as well. It's going to be fun. It's going to be action packed and structure packed as well. And if you're watching on YouTube, we love the likes. We love to smash the like buttons, get the comments, and I'll do my best to throw it in there as well. So without further ado, because we've got heaps of content, but I'm really good. Let's get to the quote a week. What is your quote? Do you have your quote prepared, Tony, or do I need to? I can go first.
You go for it first, man. I'm super excited. So I'm just super excited to listen to yours first, buddy.
Oh, okay. I was staying up late last night thinking about this, and I came up with it had to be relevant. So you can't build a great building on a weak foundation. So you must have a solid foundation if you're going to have a strong superstructure. So that's from Gordon B. I don't actually know who Gordon B is, so I should really vet who these people are to make sure that they're not strange people. But so that's my quote. It's all about sort of building the solid foundations, because if you don't have that, the structure is going to be weak. So that's my quote for this week.
I think Tony has a share screen with his quote on here. Oh, what have we got, Tony? What are we looking at?
There you go. Look, I'm just saying that the key takeaway message today, this is just very humble sharing from the bottom of my heart. I think it's really good connecting to what, Jeff, you got as well in terms of structure. My little quote is really just, if you follow this tonight, if you actually get it tonight, I think that means a lot opportunity of how it's going to change your life as well. So my quote basically says that it is not about how much you make, it's about how much you get to keep, guys. Okay, so it's not about how much you make. We're going to talk about it, particularly with land tax and structuring to protect your assets or minimize tax, right, and maximizing your benefit. So at the end of the day, guys, I think if anything that you take away today, it's not about how much money you make, right? The rich folks focus on how much you actually keep at the end, right? That's what's matter.
Yeah. Is it similar though? I mean, maybe it's completely different, but is it somewhat similar to? It's not about how much you earn; it's about how much you keep or how much you spend.
Absolutely, yeah. I just tweak it a little bit, yeah.
I went very morbid there when I started thinking about it, because it's about how much you keep. But I was like, oh, there's a time where we won't keep any of it. It all just ceased to exist. But anyway, that's too morbid. Sorry for bringing the mood down. Joe, what's your quote before I get down that rabbit hole?
Well, I've been reading a lot of accounting books recently, and one of the quotes that keeps popping up in those, it's we got to get Tony on. We got the big guns here, but profit is vanity and cash is sanity. Because you hear about these people saying, oh, I've got, all this profit coming in, but it's what's end cash flow at the end of the day. So you can make all of this profit, but if you can't convert that profit into cash, it doesn't mean anything. Do you see that, Tony? Do you see highly profitable businesses that haven't been able to convert that cash, that profit into cash?
Absolutely. Look, I think as you're probably aware, we're going in a sort of crazy world at the moment, right? You got the pandemic, the COVID, the recession, the obsessions, or the whatever's going through. I think cash is king, guys. Right now, in terms of business, going in a day where you got credits, you got checks, and all that, cash is king. Look, cash in business, even in property, we're not going to talk too much about cash flow today. Mostly structuring to protect your assets, right, or protect your equity, and so you can grow it very efficiently, right? The main thing is, look, cash is like oxygen. Is that right, Jeff?
Yeah, I was going to say, what are your thoughts on in a higher inflation environment? Can I be a little contrarian, a little controversial, and just say that cash is, I mean, of course, you need to be able to make money, but I think, I mean, we saw the CPI numbers came out today at 6.1%, expected 6.3%. So in Australia, at least for Q2. So it wasn't as bad as what it could have been, but yeah, is cash as valuable as it has been? But I get the sentiment. It is about how much cash you can throw from your businesses, from your properties, all those kind of things. So I'm being a bit cheeky.
No, absolutely.
Cheeky Jeff.
So what we got to probably be help you out with your audience as well. I mean, look, I'm super excited. I know we all been excited for a week.
Before we jump into the session, Tony, let's before we do a bit of an introduction, we'll jump into our sponsor, and then we'll dive straight into getting Jeff to introduce who you are, because I think people are going to love that, and then we'll dive straight into it. Let's.
I dug deep. I dig deep.
Awesome.
Selling a property. It isn't something we do every single day. There's actually more involved in the process than you may initially think. Like, how do you find the best agent? How do you ensure that you're going to pay the lowest fees? It's not easy, and then also throw in all the stress and pressure of selling. And that's why Scott Agate, a former real estate agent and expert property negotiator from Hello House, has created his leading agent finder service. After a 20-year career managing agents himself, Scott has personally conducted over 3,000 property transactions, along with running 3 Bell franchises. He knows all these agent tricks. Scott has created an in-depth 5-step process for his leading agent finder service. First, he establishes the true market value for your property. He uses a triangulation method to shortlist the leading agents, creates a competitive environment for those agents to send through their best proposals, vets those proposals, and then he negotiates the best agent fees for you. This ensures that you're not only getting the best rate for selling, but most importantly, you have a leading agent on your side selling your property to maximize the end sale value. Oh, and did I mention this service is completely free? If you'd like to know exactly how Scott runs his 5-step leading agent finder service, he's detailed it with the link below. Or if you'd like to speak with Scott to help find you the leading agent in your area, book a call today.
Joe is back, and it's interesting. You sort of see there was a meme that came up in the group today about agents and them sort of not being as glamorous as what they were. So interesting that we're talking. We had the thing about selling from Scott, but I'm sure there's plenty of. Well, there's probably a couple of agents watching, keen on a deal. So there is almost 100 people watching this stream right now. So heaps of comments flowing through. Ooh. There is excitement. The crowd is built. It's like the Colosseum. So, but who is this? Who is the man, the myth, the legend, Tony Lee, sitting in front of us? So I was reading up about you last night, and it said you started after. I love this kind of motivation backstory. It was your parents' business getting into financial difficulty around the time when you were 18. You sort of. This was a key kind of turning point in your life about how they sort of, unfortunately, they lost their business, and this is all public kind of knowledge. This is not me. So it was around because they didn't have good financial business structuring. So I think this is a key passion item for you. But you went on to go to uni and get a business degree, which is a common path for a lot of people. Worked for the best accounting and financial firms initially, and then decided to become a specialist accountant, sort of financial sort of services person. So, and I was talking to your brother from Lee and Lee, Peter. He was saying you've been running this for about 20 years now, roughly. So you've been in business 20 years and been kicking goals.
Yes,
so
yes, I started when I'm 10, so you just got to add up your mess together. I'm not that bloody old. But yeah, so certainly I think I only start my business, I guess, only one thing for reason, right? For only one reason, some people say, why do you do what you do? As you know, like everything, when your parents are in financial difficulty, and as a kid, we brought up, and our dream, our heart is always just want to take care of our parents, you know what I mean? So that is really what I do. See, because I believe really with our ethic and our value, our parents always also believe when we came to Australia, the great Australian dream that, that we all have the birthright of Australian at that quality of life, particularly in retirement, right? And so we really believe that every Australian had the right to control their financial destiny, or at least, have a prosper future. And so that's one thing that I do is to take care of my family. But, one thing leads to another is that I'm now passionate about basically helping my client, helping my client to plan the tax, structuring to protect the assets and business and just at the beautiful retirement planning, and helping them to make some sense out of the complexities of tax law in the complex world that we live in. You know what I mean? Yeah. So that's how I started, probably accidentally, but anyway, here I am. I'm doing what I love to do and passionate about talking to you guys.
Yeah,
man.
That's I love that kind of. So that's a great passion, and it is something that we are very blessed to have here. So in this they call Australia the lucky country. So good on you for giving it a go, and that's awesome. So the thing we start off with a lot of is people's first property investment. So could you tell us about that first investment and how it all went? Like, I see you smiling.
That's the face of a man that's made some mistakes.
If we said that, you might be going through a little bit some time ago, and make me feel a bit old, right? But look, long story short, our very first property is actually probably going back 1983, straight after uni, probably 94, 95. And then we start buying some investment. Probably my first profitable investment will be the first 3 townie, in a deceased bankruptcy sort of type of acquisition where the debts are probably 80,000 each. We bought it for pretty much 80,000, right? Through a very special strategy, and ultimately the value in itself is probably already 130. But what's important is not where I started from, probably where I'm doing now or where I'm heading. I think that's what's important. Yeah. So our very first one probably be a family home, and then leading towards our first 3 investment property, by the way, which we still have, and you could not believe what its value now. Yeah. So that's over 20 years.
You paid 80,000 for it, and it was worth 130.
Over 80,000. So 8 by 3 is $250,000. So back in those days, it's a lot of money. So you kind of buy that with no money down, because the value itself is about 135 each. But now you don't want to ask me how much the property is valued now. It's a lot.
I could probably guess, but yeah, let's just say probably a few more clams than the clams you paid for it. So you said it was valued at you said it was an estimated value of 130, 135, but you paid sort of 80 roughly.
Yeah, absolutely. Yeah. So all I got to do is come up with enough money, $80,000 to pay the bank, right? And I control 3 property. That's worth at least 135 each. And 12 months later, it's worth 150, because the real value is 150, not 80, because the 80 is how much it owes the bank. You know what I mean?
How did you find this deal? Like, what was the process in those whenever you bought the
I'm not sure it's the reception hiccups here. I didn't hear all the questions altogether. But look, long story short, I was working as an accountant in a specialist insolvency firm, and as such, you got a bit of maybe inside information, and you see that people going broke and they have to sell the property for what it's worth. And I just thought, well, it's actually not a bad area. I might as well buy one, live in one. And I was supposed to actually give one to my brothers and give one to my sister. And at the end of the day, we're all living in one. So it was a good thing is that we end up renting the other 2, right?
Sounds like a bit of house hacking situation.
Yeah, that sounds like a little bit of insider knowledge there. And that's kind of what I like about the property market. There's a bit of a disparity there's a bit of a knowledge gap between things. Like with shares, it's very crystal clear that you've got the earnings, you know exactly how much a share is worth. But with property, it's a little bit more hidden. It's harder to know the exact value of a property. And then that gap is where you can have some insider knowledge without breaking the law, like you had, Tony, understanding that some people are going through some insolvency and they need some quick cash, and you were able to help them through. Are these type of deals still available out there at the moment? Like in this day and age?
Well, look, guys, at the moment, we're probably in a perfect opportunity, right? When you're going through the inflations and the crazy economics and the markets going out at the moment. But look, one of the things is that I'm going to share with you later, aside from what we are about to jump in, is the 5 reasons. The absolute 5 reasons. I'm going to summarize it. And we're going to, as I said, over the last week, we're going to talk about how to actually make very complex world of tax into as simple as possible. And we're going to make it really fun. So I'm going to give you 5 reasons why the rich folks or the Aussie absolutely love trust. And we're going to break it down, and we're going to show you how after tonight, you're going to understand trust, and you're going to be, regret that you don't even have one, right? But, we're going to break it down. We're going to share with you why trust is good and why rich folks use trust, and how you actually use the right structure, not only with a focus, with a big end in mind focus, that you're using structures not to avoid tax or minimize in such a way with the attention to risk, but also, structure for the estate plan, the succession planning, the protecting assets, so that as we mentioned earlier on in our quote, what you want to do is to focus on, not so much how much money you actually make, what you actually kept at the end makes sense, right? So we're going to show you that how, trust is going to provide you that sort of a type of benefits and actually give you the peace of mind. At the end of the day, I think Aussie and property investors, we want that peace of mind, knowing that when we eventually do sell the property, we're going to probably get as much benefit as possible. And the other thing is, I'm going to talk to you about maybe the difference between control and ownership. So if we do have a time on that, and if you can remind me, so Tony, what's that big takeaway that we're going to end up having tonight in terms of how the little tips that I've learned from wealthy investors on controlling assets over actually having an ownership of an asset? Okay.
Yeah, I love that. I'm super excited to jump into that. But one of the questions I do have for you, Tony, is from an accountant's perspective, not every accountant is pro property, and you're very pro property. You're in the property industry. You understand property, which is actually a top tip for a lot of people that are looking for an accountant, is make sure that an investment savvy accountant has their own properties, is doing the things that you want to be doing. But why property? Like, from an accounting perspective, why are you so interested in property?
Well, I think if you look at this slide here, amazing that you mentioned that, right?
Hang on. Okay, well, before we go into that, one thing I did want to share, just to cover our butts, is a disclaimer. Information on this presentation recording is for general purposes only.
The honor of disclaimer.
This is not professional advice. Anyone appearing on this video, read this. We're not financial planners. You should consider seeking independent legal tax advice. So we're going to say some pretty general statements at time, and you need to speak with a qualified accountant professional and do your own due diligence on these type of things, because trusts aren't for everyone. And there are situations when they are good, and there are situations when they're not so good. And we're going to dive into that anyway. And Tony, you're an accountant. We are in your trusting hands. So let's jump into this slideshow that you've created for us. So what are we looking at here? I can see your screen now. Property and negative gearing is a part of our DNA.
So you know how you mentioned about why property. Look, I mean, property as an Aussie, I consider myself Aussianized, right? When you've been in Australia that long, right? Well, hang out with you guys, and pretty much I feel like Aussie brothers, right? But look, I think, as you know, property, it's almost like part of Aussie DNA, right? Negative gearing, probably when I first started, I mean, still sort of lingering in your mind and your ears, right? In terms of negative gearing. But definitely, I think property is something simple, everybody understand. I mean, even my mom and dad understand, right? If you don't understand, why you buy a lot of it, right? But also property, I think it's just, probably from since I started investing, it's just part of this Aussie culture, the Aussie DNA, right? Feel like everyone else, pretty much everybody wants to have a bit of a dip in the property. And here's the thing that we found when I did a lot of seminar, particularly with Belinda, and a few other sort of like last time when we did it together with you, Joe, right? It's not surprised that a lot of people actually jump into renovation, right? Because as I said, they understand property. Renovation, subdividing is something that, they can understand that you can actually either hold it to increase value, or you can put a little bit of a TLC and, put a bit of a value into to make sure that the property can pass on to another buyer. And hopefully, they're going to love it. And if they enjoy what they've been buying from you, they're willing to pay for the price for all the hard work you put together. Yeah. So I think my sharing is that property has been a pretty much bread and butter part of our life. You know what I mean?
So when you say negative gearing is in our DNA, is that a good thing or a bad thing?
Well, this is the thing. This is the thing that I guess in terms of accountant, as you see, a lot of the strategy outside are surrounding about buying a property to reduce your tax, or how the tax law allows you to own a property and actually reduce your tax or give you a bit of a refund. So that governments are encouraging you to hold on to that property, and thereby, as an investors, we find benefits of buying property. So then you can actually, help the renters, in terms of people that might be unable to afford to purchase a property. The governments are encouraging that, so that you feel like, well, it doesn't really cost you as much as what it meant to be costing you, because you've got a bit of a government rebate to help you. But what you've got to be careful about, in a minute we're going to touch on having a trust, having a different ownership structure, is that the property, as you can see, over time, the property grow in value. But when the property grows in value, where you got particularly like now we enter into a growth market, you got a massive capital gain, and if you decide to sell it, that's where the government's going to basically have a bit of a share of the cake, aren't they?
Yeah,
they've got to get
pay back all those benefits.
100%.
Yeah. So
okay, well, what do we want to get out of this session? I feel like
this is a question for the audience, I believe. This is the what do you, the audience, what do you want to know about structures? What do you want to know about accounting? And there will be plenty of opportunities for Q&A. So throw these along, but we'll look to tailor as best we can. But I think there's going to be a masterclass on structures and structuring as well. So I'm excited.
Okay. Well, yeah. Okay. Well, there you go. Let's start off there with why are structures so important? Like, what is the actual purpose of these things?
Yeah, absolutely. So, Joe, as I said, before we go into structure, probably one of the big things, as I share with you over time, is that most of the time, as an accountant, we're not your typical accountants or number crunchers. We are obviously, as you know, a property specialist and expert, business strategy and SMSF specialist. So, over time, when we sort of see client, the first thing that we actually do is actually a second opinion, meaning we look at review where you're at now, where you're going, what sort of structures do you have, what sort of asset portfolio do you have. So one of the things that we do is that the first thing we do is actually reviewing your current situation, no matter what you do. Now, every time, I just want to say this to you guys, right? Every time we actually conduct a free review session or discovery session, right? Inevitably, most often case that we see is that every client that we have conducted over the last 10 years either overpay tax or have an incorrect structures, right? So this is why we want to talk about structures is important as part of your investing as well. But here is probably some of the biggest frustration that people do get if you actually get the structures wrong as well. So one of the things that I noticed that if you actually get the wrong structure, structuring can be confusing because a lot of people actually hold back. Should I buy my name? Should I buy it in a company trust name or even in an SMSF, self-managed super fund, right? And so one of the things that I think like Jeff, your quote touched it really, really importantly, correctness, is that when you actually get the actual foundation correctly, it's so critical because a lot of the time when people actually get it wrong, it can actually mean that it costs you a lot of money, because particularly if you're going to make some changes and all that. So common things that people gets it wrong is that it could be that you actually buy in a wrong ownership for wrong circumstances or wrong objectives. So when this happens, most people struggle, particularly like with finance or growing the property, cash flow, taxes. And so it actually prohibit them from growing their property portfolio.
Okay, well, let's jump into some of these. So I'm just kind of cautious of time. We're 25 minutes in and we're into slide 3, and there's a boatload there. So let's jump in and start talking about what exactly is. I imagine you've got a prezzo on what a structure actually is. Let's start talking about and kind of giving a run through an overview of what exactly these things are.
Yeah, so Joe. Yeah, so one of the things, as I said, is that what we want the audience to get out of today, obviously getting the right structure, meaning having the right structures and tax advice is really critical. Obviously, everybody wants to pay less tax, but really what you want is the certainty and having a confident result at the end, right? And, as I said, everybody wants asset protection, but really what you want is controls and security, right? So one of the things that we always talk about, particularly with property, is that you really need to consider like talking to you as a buyer's agent as well. When we refer client to you, or when you talk to our client, we want to make sure that you understand our client strategy, meaning buy a property to renovate, to keep, or to sell, to subdivide, now or later, or even to develop, right? So first thing we do is we definitely talk about strategy. But the other thing we do talk about, which is what we're going to cover a lot tonight, is the actual structure side of it. So structure means we're talking about company, trust, and self-managed super fund, which is really structure mean the ownerships of the actual property. And finally, we're going to touch on a little bit about taxes, because if you don't get the tax advice right, it can actually put you back a lot longer in achieving your goal. Alternatively, it can cost you a lot of money as well. So the reason you want to...
It's interesting there you haven't included individual. Is there?
Well, individual? Yeah. We got to touch a little bit of that on a individual, particularly when you started up buying in your first home.
The diagram was too big already. You couldn't fit individual.
Yeah. And then land tax kick in. Maybe if we got a bit of time, we might touch on just a little bit. But this is rich folks, right? If you're serious about investing and your intention is to take care of your family, as I said, and you want to leave a beautiful dream or legacy to your family, and you want that flexibility, you want to control. In a minute, we talk about the secret of having a control over ownership. So having property in your individual name is ownership. You own everything, correct? As opposed to I individually control asset that I don't even own, right? Because this is the thing, right, Jeff? When you actually structure strategy correctly with the right structure and surround yourself with the right tax and trusted advisor, or property tax specialist accountant, there's a lot out there. You just got to obviously know one of them, right? So the main thing is that when you structure correctly and you got the right strategy, not only you're giving yourself an opportunity to grow your asset, you're also protecting. And in a minute, we talk about when you're controlling take place, it's amazing that you also got the flexibility and ability to plan and minimize your tax or maximize your return that way. So this is the first thing we talk about. Now, when we talk about strategy, this is all a beautiful sort of a slide that I put together. There's so many strategies to make money. I mean, I even included your favorite there, Jeff, Underbelly, right? You're one on a member, right?
New work market, network.
What is Underbelly?
Yeah, there you go. So today we're just going to focus on the red part, which is basically property. Now, and as you know, Joe, when we talk about properties, there are tons of strategy, right? These are actually some of our property strategy, property ownerships and property development, and some of my client, and that's something that we invest in as well. So in terms of property, as I said to you earlier on, really property is just part of our life or our culture, right? It's in our DNA. A lot of people actually like renovation, subdivide, because they understand, right? So one of the things that we always talk about is the choosing. I think it's so important is to actually, and this is touch on the ownership structures, or at least just choosing the right property wisely. Now, when I say choosing the vehicle wisely, is that if you are buying property under the wrong entity, right? When you, Jeff, you know how you mentioned, I don't mention buying property in your name. Well, buying your name is not wrong. You know what I mean? Particularly if you want to buy it for yourself to live in, to retire on, because it's tax-free, right? You don't pay land tax and you don't pay capital gain when you sell it. But if you do buy it in your name, it's simple. In a minute, we're going to touch on the benefit. But what I'm saying is on a long term, if you do buy property under a wrong entity or wrong ownership, the effects of, the taxation, the flexibility, the planning opportunity, the cost that when you want to transfer from your personal name to your brothers or your sisters or your wife or your kids, later on, that can be, a high amount or an additional fees that involve, particularly if your circumstance change. And when you're going to decide that you're going to make the changes down the track, it's going to cost you a lot of money. So if you want to make sure that you want to invest in property, you definitely really want to talk about buying in a correct ownership structure. So this is what I talk about. Yeah. Choose the right vehicle, basically ownership.
You've got three vehicles here. We've got company, trust, and SMSF. Is that are these the only three vehicles and structures?
There you go.
Okay, here we go. Yeah. There we go.
I just put the individual just to please Jeff, right? Just to make sure that we haven't missed out too, Jeff. There you go.
Yeah. Yep. So what I like is you break down the complex into the simple to make it a lot more digestible to understand, which is great. And how does corporate trustee fit into this this scenario, would that be considered under a trust or under a company?
Yes. So remember we had an amazing discovery session, and you got a bit of a light bulb, right? Buzzing out. Yeah. So corporate trustees, it sits on top of the trust. So corporate, we'll touch on that shortly as well. We touch on that shortly.
Great. Is that what we call a bucket company, or is that something different again?
Yeah, something different again, Jeff. Yeah.
Okay.
Bucket company is a corporate beneficiary, not a corporate trustees.
Okay. Yeah.
Right.
My understanding, and correct me if I'm wrong, isn't an SMSF simply a type of company, or what makes an SMSF?
SMSF is simply a structure, Jeff.
Okay.
Yeah, it's like a company, it's a structure, but you can actually have your superannuation, right, control for yourself. Again, we're going to touch on a little bit because obviously it's actually recently a very hot topic as well. So we're going to touch on that. But one of the things that I think what we need to do is that you really got to think about before you think about the property's selections or ownership options, right? Structuring, you really want to think about the purpose of buying the property, all right? Because, you know, you got to ask yourself, is this a business arrangement or investment arrangement? Is this a short term or is this a long term property acquisition? It makes a big difference, right? So if it's a long term property acquisition, particularly for holding, and if you believe that, you know, you want an asset to hold on, particularly protected because you're a high risk individual running a business or operating a high risk business activity, well, being an underbelly member, that's pretty high risk activity for you, right, Jeff? You're in, right? So you need to consider having your assets in a trust structure. But look, if you're looking at long term, what we're trying to say to you is that there's a benefit of having in a self-managed super fund or in a trust, right? Far more beneficial than having in your individual name, particularly if it's an investment property, right? So you got to think about your circumstance and your objectives long term, because when property, just consider your current situation, your future objective, and your circumstances changes, and then make sure that if you cater for all the circumstances and your current situation, your future objective, then you'll be able to basically choose the right ownership structures in terms of holding that property. Now, so as I said, before you do all that though, this is something that we're talking about. You really got to consider the degrees of controls and ownerships in terms of risk and asset protections or current tax and future tax, and particularly the flexibility you need. Again, you know, we mentioned a little bit about the new government, Queensland government land tax rule coming in, and whether or not, you know, you're buying a property for holding or even, you know, subdivision or development where you actually potentially you might need to bring in investors or joint ventures agreement. So these are a few things that you need to consider. Now, the aim of and the objective is really, you know, really twofold, right? You know, when we talk about cash flow, how do we maximize the cash flow coming in, how to minimize the cash going out, right, which is the actual taxes, right? Also how to get the flexibility, and as I said, you know, it's not how much money you make, it's how much money you get to keep. So, you know, if you get into trouble, your creditors are going after you, what you want to do is make sure your assets are protected and segregated. So if you are at risk, you will lose some asset, but you're not going to lose all of it. So these are some basic sort of objectives that we're aiming to achieve.
These are the main reasons why people consider using a trust, is to protect their assets, limit their own liability. And this is where it gets confusing, I think, is that you're throwing a lot of variables at us right now. You're saying, you know, is it short-term, long-term? What kind of job have you got? What kind of risk level have you got in your occupation?
What kind of income as well?
Yeah, what's the income? So this is where it gets really, really quite confusing into knowing what's best for me. But yeah, sorry.
Can
Let's go, Jeff.
let's throw a bit of a curveball, because I think everybody at home is probably thinking this. And this is from Brennan. He said, "Is there a portfolio value that once reached, structures start to become optimal?" I'm interested in I've got some thoughts on this, but what are your thoughts, Tony, on that one?
So I've got an example. So Brendan, maybe hold your horses a bit. We're going to go show you
all right.
real life example.
I just wanted to really hammer home a point.
So you remind me on that. Now, as I said, we're going to touch on control and ownership, but really the first protocol is to consider all, in fact, these are actually some of the consideration, right? And so once you consider that, as I said, the key, in fact, what we believe in is just creating the asset protection and the peace of mind, so that you can actually sleep at night. We all want to sleep at night peacefully, right? That's really what we believe in. So remember we talk about these 4 different ownership structures. So let's just dive in really, really quick, because everybody basically know anyway that you can actually buy a property in your personal name, in an individual brother and sister, like me and my brother and my sister, or in mom and dad's name. And this is how it look like, right? Either you started up buying your own property, either to live in or as an investment. And this is actually, by the way, that's one of my first property development. There you go. And I still got that one, right? 1 into 3, right? That's after, when I learned a little bit about the art of property development. So, by the way, I didn't buy it in my name for that one, because I learned a lot of mistakes I make along the way, right? So you can actually buy in your name now, which is a personal. I know, as you guys already know, right? And most people probably already know that, right? When you buy property in your name, the pros and cons in terms of the advantages is really simple and easy to understand, because everybody wants to have the property in their name. As I said, you still got the benefit of negative gearing, provided you don't live in it yourself, but you're renting it out, right? Now, the things to consider, which is really the disadvantages, is what we see as a practitioner, as a specialist over time, particularly when you own quite an amount of property over time. In my own portfolio, is that when you become like an accountant or a specialist developer or business advisor running your own business, like you guys, you need to start thinking about asset protection, right? And you start thinking about, if I start making all these income becoming positive cash flow, and if I'm going to have to sell the property now in the future where I'm going to get a huge capital gain tax, right? Bingo, you don't have flexibility. You cannot stream the income to your missus and your kids, right? And so these are some of the things that you do need to consider. And coming back to Joe, like you mentioned about how do we know, what to consider and what are things that we need to know? Well, that's what you get an expert like us as a trusted advisor, especially a specialist. There's a lot of bunch of advisors out there as well that specialize in property, because that's what we do day in, day out. We do a lot of this every day, right? So this is probably the first one in terms of buying property in your personal name.
Yeah, and that's why I want you to share the secrets, Tony. That's what we want. We want the secrets of unpacking the hidden stuff that's behind the curtain. That's what I want to hear about. But the cons here, I want the juicy bits. No holding back, mate. No holding back.
The funny part is, because I knew you're gonna ask me the question, I leave the juicy part to the last minute. So you're gonna hang out with me for another maybe half an hour, right? We're gonna get there. The way I'm going, I think we're gonna get there very fast. Now,
no.
So the second,
just going back to this one, right? On the individual side of things, no flexibility of a distribution of income and capital gains. So
just even investment property we're talking about, yeah.
So no capital gains. So you get a capital gains tax discount after you have an asset over 12 months, a 50% capital gains tax discount.
Yeah.
But I think what Tony's saying is there, though, is let's just say you've got one person earning all the income, and that's owned only in that individual's name. Then you can't then distribute all that gain to somebody who may be on a lower or almost no income. That's what he means by lack of flexibility.
Yeah, absolutely.
Okay.
You see later on. Look, to be honest, I think the best in both worlds. There's no best structures, right? Or best structure fits any particular circumstance, right? But if you think about like what I do, I got property in my name, in a company name, in a unit trust name, in a self-managed super fund, and in a various different structures. You know what I mean? So you got a best of both worlds over the flexibility that you need as well.
Yeah. So what is, like, if we were to pinpoint something as the best thing to buy as a property in a individual, would we say it's a PPOR? You buy the best, like it's a better situation to buy your PPOR. Not that we're giving out advice, obviously, but you want to buy your principal place of residence in your individual name rather than creating a structure around it because it is tax-free if you use to sell it. So that's my thoughts of how it works. Is that probably too short-sighted or spot on?
Well, look, I think the key is actually planning, right? And understand where you are now and actually where you want to go, what's your ultimate objective, But, as I said, as a starting point, you probably already seen a lot of the situation, particularly if you're buying a property as your first property. And often, I see that when people buy property, generally they buy in the name first, being the first property, either your first PPOR, just like I have my own first PPOR, and I sell it, and I buy my second, I buy my third. So it makes sense that I buy in my name because maybe I don't, like, even as an accountant, funny enough, right? I understand company trust, but I didn't understand to the degree that I understand now. So I still buy property in my name, or even buy it in my individual name because there's a lot of benefit in in negative gearing. Right. So, but I think where a smart investor, and this is if anything at all, the audience and even yourself take it away tonight is that, if you now know the land tax threshold is $600,000, particularly in Queensland, for those people that live in Queensland or viewer from Queensland, your first principal place of residence tax free. So, and it's land tax exempt anyway. So it makes sense that you might want to buy it in your name, right? That's provided you're not going to enter into a risky business, in the future. Right. But you always got strategy for that anyway. Now, but if you're buying investment property in your name, if you think about land tax point of view, and not many people think about that in the last 20 years, right? So land tax just creeped in the last few years. So if you now know that land tax cuts off at about a maximum threshold of 600,000 in Queensland, then it starts to make sense that you can hold a particular property in your name, maybe up to a land tax threshold value, and you're going to start thinking about buying in, you start going to have to learn how the rich folks or smart investors, investing their property if you're going to grow it. So today's session is really about how to grow your portfolio and using a smart structure. So you're absolutely right on point. If you buy your first home, if you really want PPOR, simplicity, negative gearing, minimize your land tax up to 600,000, in your name is perfect. But as soon as beyond that, I think that's where you start sort of thinking about and options available out there.
Let's go to number 2.
Let's go. So number 2, this is the fun part. This is my favorite, guys, right? This is my favorite, family trust discretionary. Now, today we probably don't have a lot of time because this is really a trust 101. So we're going to simply talk about discretionary family trust, right? So we're not going to talk about different type of trusts available out there. We're simply going to talk about discretionary family trust. Potentially, also we're going to touch on just another type of trust structures called the unit trust. So the other things that you're going to look at is that, so instead of buying a property in your personal name, you can actually buy in a discretionary trust name. Now, you buy in a trust name, but technically speaking, what you want to do is you want to set up a corporate structure. We call it a company. So we don't suggest that you having, if you want an asset protection and you want to borrow a lot more money, and the banks are really favor using a corporate trustees, meaning a company on top of your trust. So what it means is you set up a company, you are a director and shareholder, the banks only see you, the public only see you as a director, it owns the property, but for the benefit of the beneficiary, because the trust actually, the ultimate from a tax perspective, right? The trust lodge a tax return, and there's some confusion there. Sometimes some investors, I'm still surprised that they're thinking because the company is the legal ownerships of the actual property, right? They thinking that the company is going to be the one lodging tax returns and having the ABN, but it's actually when you have a company trustee for a trust, is a trust actually lodge a tax return. So the one of the biggest benefit in having property in a trust, as we sort of mentioned to you, is the flexibility that you can actually, in a minute, we're going to talk a little bit about example, the flexibility in distribute your income and also the capital gain and into a bucket company, which what a lot of rich folks actually using. Now, aside from the fact that you got taxation, tax benefits in terms of planning and reductions, strategy available for you, you also got, a great deal of asset protection if you use a corporate beneficiary, not an individual. Okay. So the other negative, I suppose, the disadvantages of having a trust is that it costs a bit of money. And obviously, trust law is a little bit complex. Some people argue that there's no negative gearing if the losses are in the trust, and that the trust assets, or in terms of profit, when you do sell it or when you got an income, you might not be able to, you have to distribute it out. It can't stay in a trust. But I'm going to show you, if we got time, a strategy how you can do that by putting it.
Yeah, definitely want to see the strategy. Yep.
Yeah, but probably one of the biggest negative is people claim to think that, well, if I buy a property in my trust, I can live in it. But if I do eventually sell it, I might not be able to get the main resident exemption. That's the general sort of disadvantages that our trust potentially provide you as well. So these are kind of like some of the basic pros and cons, guys. Okay.
So one thing I feel like we've just kind of skimmed over a little bit is that there is a trust, there is a discretionary trust, and then there is a corporate trustee. So what you've done is got a trust and a company and merged them together and created something called a corporate trustee, which is like a super trust. Is that what we've done just now?
Not quite.
Yeah. So there are a lot of So what we have done, as I said, is that we put in this instance, we have a company as what we call corporate trustees. So one of the benefits of corporate trustees is that you as an individual, right? You're not the actual trustees of a trust, because every trust have to have a trustees and a beneficiary, right? So you are the beneficiary. Usually what mistake people make without getting a professional and specialist advice is they're trying to either save on costs, or they don't know what they don't know. They use individual as a trustees that actually act as a trustee. So when you do that, you don't got no asset protection, right? Because one thing that I think audience take away today, you see that one of the secrets is that rich folks actually use a corporate trustee, which is a company, because it gives you the additional protection, the asset protection, and the actual corporate shield. So when you actually have a corporate trustees, what it actually do is that it actually gives you some kind of a privacy as well, Joe, because legal ownership is actually the property is actually owned by the trust, in a sense that the actual trustees is the ownership, right? So when people actually look into the actual corporate trustees, they only see you as a director. So you as a director, you actually control the trust or control the the management, but you actually don't own the property. The corporate trustees own the property. So it gives you kind of like extra layer over the asset protection, right, and limited liability, but it gives you that privacy benefits whereby someone actually want to find out who actually owned the property. They've got to do a little bit more deep search before they actually found out who are the director and where they live, right? But if you put a corporate trustees, it gives you that privacy and the actual protection. Okay. So actually, with the trust, right? The actual what do you call it? The we talk about another benefit is being an asset protections or even flexibility. We're going to unpack that shortly, where we're going to go through maybe an example you'll see, and also when I summarize it, the 5 benefits, and then I'll unpack the real example. You can get to see the how company and trust actually in operation.
So can I just have a trust, set up a trust by itself, and then purchase property under that?
Well, the short answer is no, because every trust, you need to have a corporate trustee, or you need to have a trustees. As I say, sometimes you use trust. So you use corporate trustees or individual as a trustees. So you can't just have a trust and buy a property.
Yeah. Okay. Great. That's why we need to combine the two, because you can't hold assets in a trust. The money has to flow straight through them every financial year, and that's why we create the company, which kind of catches the assets at the bottom, and then distributes them through the trust.
As I said, the legal ownership of a trust is really the trustees. So you really need to have a trustees. There's only 2 ways of doing it that I'm aware of at this point anyway, is that you can either use you individually as a trustees, right? Or as I said, what you want to do is consider having a corporate trustees. And the reason is you got the privacy and the actual asset protection and limited liability.
Yeah, perfect. Nice. Okay, cool. What else we got?
We're gonna unpack now. The third one is company. Okay. Now, some property developer, again, we're not gonna touch on too much of this. We're just gonna skim through really briefly, because I want to jump onto the example, and then we can have some Q&A on that. Now, so the third one is actually a company. So a company looks like this. Now, I think I'm gonna got rid of my simple slide, but this is what a company look like. So you have an ABC Pty Ltd, all right? And then you obviously got to have a shareholder, and usually we suggest using a shareholder trust. Now, one of the three benefits of having a company is that as I mentioned earlier, if you use a company as a corporate trustees or a company as a trading entity. So this one here, Joe. So don't confuse that the trust, a company is trustee for a trust, they actually own the property, but this one is actually the company owns the property, not the shareholders, right? The shareholder is actually a trust owning the share in the company. So the legal ownership of the property is a company. So one of the three benefits you see that in a company, in fact, if you're a property developer, company get to actually tax at 25%. So that's a sweet spot. The kickers in it where a developer or business owner or entrepreneur, they would use a company because it's easy to understand. The bank will lend you money. You got the limited protection that you need, and it tax very favorably at about 25%. Now, just understand that if you are property investors for long term, you probably don't want to consider using a company. The reason is company doesn't get the CGT discount or the 50% exemption like the trust or an individual gets, right? So you want to make sure that you want to choose the right company or the entity structure for a particular outcome. So if you buy a property, get in and out really quick, company is not bad. If you want to be taxed at 25 and leave the profit and go and do another deal. But if you're going to buy long term, company might not be a best structure. Again, if you want to go after the 50% discount, particularly if you want to sell the property, then ideally company is not the best structure. So you just got to make sure you understand what is your current objective and what you're trying to achieve, and what's the best structure that help you actually minimize your tax and protect your assets.
So this would be more of like a renovation flip, right? Where you're adding an extra bedroom, you're adding an extra $200,000, and then you put the property on the market within 3 months. You wouldn't be eligible for capital gains tax, but you would then be able to then you would be able to take your profits and move on to the next deal.
Yeah. So if you look at this is actually one of our client, like a splitter deal, right?
Yeah. Can you talk through the flow of money through here? Like, what does the flow look like to give us like on your chart so we can kind of understand a little bit more?
So let's say you buy this property for $1 million and you built for $1 million. So simple, $2 million. And if you got no bank coming in, right? And call it $3 million. So there's three shareholder, 1, 2, 3. We all chucked in, three of us, Jeff, me and you, we chucked in $3 million in, either by way of share issues or loan. So just to keep it simple for today audience, we both loan, the company, ABC. I represent A, you represent B, Jeff, you represent C. So there's three of us. We contributed $1 million each, $3 million. We get the buyer's agent, good old buyer's agent. Well, why not? We use Joe. He found the site for us. We buy it, we develop it, and now there you go, the beautiful property there. If we sell it, we might say, just for argument's sake, 300 grand. Okay, so we put in $3 million, right? We contribute the money the way it is without the bank, and we bought the property, we develop, we sell it, and we made a net profit 300 grand. Forget about all the GSTs and all that. So that's a taxable income or a profit that got to be taxed at 25%. So the way that the company work is that the benefit is we can leave the profit in there, so that our $3 million plus the 300 grand, and we go and do another deal. That's the beauty of it as a property renovator or an investor developer. But if we decided that we want our money back, so the money after you sell the property, Joe, the $1 million go back to you, okay, which is your capital. Now, the $100,000, you'll be taxed at 25%, right? And the tax at 25% is called imputation credit, which you pay to the ATO. But we can actually stream the actual profit being 1/3, 1/3, 1/3. Yours has been 100 grand back to your family trust, okay? So you've been representing B, as I said. So we'll be streaming, for argument's sake, 100 grand paying dividend to three of us, 100 grand each to everybody. We take a net profit of 75, and then we got a credit that we already paid to the ATO, which is called a franking credit, 25,000. So that's how the money flow back. So money goes in as a loan, right? As this example, and then money comes back out as a loan repayment. And then when we do make the profit, 300 grand, the whole 100 grand, you're going to get taxed at 25% first, which the company have to pay to the ATO. But when you get distributed the share holding, the dividend, it will distribute it to A, B, and C, which is a shareholder. And you being representing A, B, and C, each of us will get 100 grand gross dividend, which is basically 100 grand. But the net dividend, which is what sometimes called franking credit, frank amount, will be basically 75. But the franking credit, which is a tax that the company already pay, right, is $25,000, which is 25%. You get to take it back to your own family, and you go to see your own accountant, and then you get to deal with your own tax individually. Okay, so that's how the money flow in and flow out.
Yeah. Okay. So let me just break this down into, so I understand what the hell you just said, because if anyone feels like me at the moment, they're like, oh, what? So you make $100,000. You make $300,000, and there's three people. That $300,000 is split individually, so it's $100,000 between each person that gets it. It flows through the company. The company pays $25,000 in tax.
No, the company gets taxed first. So you make 300 grand.
Yeah. So the first company, ABC company, property development company,
on the whole the pay tax on the
whole
on the
300 grand. Oh, okay. Sorry. Yep. On the 300 grand, and then that $100,000 is now $75,000 each. So everyone then gets distributed $75,000 and a $25,000 franking credit. They then get that $75,000 in their own name and just into the trust, and they distribute that to everybody. Now, the government's saying, we don't want to tax you twice. We just want to tax you once. So we've got this $25,000 franking credit. So if we distribute it to, you, your wife, your other wife, your kid, your other kid, and your mum,
you got to be careful with minors, Joe. So let's
Well, if you've got maybe we can talk to how you distribute to minors.
You see an example here, Joe. You see an example.
I've got and then I'm
just got to step in there because people.
Let me just finish this. Now, we've got a few more left over. So as I said, another option is unit trust. We're not going to cover too much on this. What unit trust really means is that you can actually identify and also have what we call a capital entitlement separately owned by A and B. So let's say you and me, or you and Jeff decide to do a property development or property ownership. Another way of doing it, for again, whatever reason, you want a simplicity, you want to have it under one ownership instead of having a two ownership. You put in a company as trustee for a unit trust instead of family trust, right? Because two of you are not brothers or family, so you separate it. So you want to actually make sure that you actually separate the assets, so you have your own entitlement. So if Jeff say, oh, I'm going to own 25%, that's A, and then you can actually own 75%, that's B, right? Now, so then you can actually identify them. Alternately, you two own 50% each of the property. But now, you actually don't own the property, Joe. You can see that in here. The actual company trustee for the ABC Trust actually own the property, control the property, but you guys just own shares or units in a unit trust. Now, so just really quickly, I'm not going to cover too much on unit trust today, but one of the benefits of a unit trust, you know how I say that the company don't get a capital gain tax if you hold it more than 12 months and sell it. But here's the thing, unit trust. Now you get the benefit of the CGT discount, and on top of that, you also got the flexibility to distribute your income and capital gain in the future. And on top of that, you got the identifications or the ownership interest. Okay, so that's another sort of a benefits of having a unit trust. Again, sometimes unit trusts are not well liked by the bank, and also it might not be easy to understand. But certainly, it depends on individual. But there are some sort of things that you got to consider. As I said, sometimes bank doesn't like unit trust because of the complex structure. Also, business profit. If you do make a profit, like the way in a company, the profit can stay in the company. Whereas with a unit trust, the profit have to flow down to the unit holder. We're gonna probably use an example on that one. Let me just go into really quick. Last example on self-managed super fund. We're not going to touch too much, but I know it's a hot topic. I know there's been a lot of inquiry on that. We're going to touch on really, really quick, right? We're going to fly through it quick. Then we're going to jump onto the real example, because that's where the juicy stuff in, right? And then I'll probably potentially give you a bit of like a few minute summary, and then you get to see the actual summary on that. So look, probably before I tell you what, before I'm going to jump, because I'm worried that I might not have a lot of time on that. Probably one of the things that I mentioned to you, the little secret is this bit, which I showed you before. Let me just see. Where's the little secret?
So while you're finding this one, throw in any questions that you guys have about what we've just covered off, because I do want to make sure that everyone is understanding where they're at. About trust.
I think the key thing I want to, because a lot of it has talked about developing and making profits and all that. I think if I'm a buy and hold, I've got 3 or 4 properties. How do I then? I mean, obviously, this all brings back to, you can apply all of these same principles, but that's what I'd love to see, because I'm sure there's a lot of people out there are doing developments and selling, but there's probably a heap of people just doing buy and hold, building property portfolios as well.
Yeah, maybe we can go through some of those examples of like, what do you typically see clients do that buy and hold? What do you typically see people doing developments? What do you typically see doing flipping renovations?
Absolutely.
But before we jump into this next section, let's jump into our final sponsor post and jump into that, and then we'll talk about ownership and control.
Commercial property offers the highest cash flow in Australian property investing, offering exceptionally higher yields than residential. Now, we're talking 8 to 10% net yields. That's cash after all expenses, not this 2 to 6% gross that we see in the residential space. So for those that are starting out on their commercial investing journey, it can be exciting, but it's also a step not to be taken lightly. The expertise of a commercial buyer's agent can pay dividends to help you secure that high cash flow and high growth potential property. And this is why we recommend Steve Polisi of Polisi Property. With over 6 years experience in the space, Steve has over 1,200 property transactions under his belt. He has seen it all and knows the best locations right for growth. In a previous life, Steve was a chartered mechanical and structural engineer, so he draws on his mathematical and analytical skills that he's developed to break down what works best in commercial property. As with engineering, same goes with commercial property. It's based primarily on the numbers. So if you're curious about diversifying into commercial property, you have access to $100,000 in cash or in equity, book a call with Steve today and find that perfect asset for you.
Do it. What have we got here?
Awesome.
We got Mr. Kiyosaki.
That's it. Yeah. So, these guys are very, very famous guy, talks about the rich own nothing, right? And control everything. Do you remember that quote?
Yes.
Yeah. So I'm going to demystify this. I think one of the things, if our audience and viewer actually gets it, this is actually, I actually come up with this during my seminar when I was presenting. So I'll quickly sort of like take some note down and make a point that every time I do a bit of a sharing, I make a note that I make sure that I make a big distinction difference between ownerships over control. So here's the thing, guys, right? Ownership versus control. What you got to think about this, right? When you actually have ownerships over control in terms of, like us as a human being, we often really funny with a tendency that we want to literally control everything, right? And we want to basically like own our home, our boats and everything, right? Now, but here's the thing, right? When you actually come up with control over ownership, it carries no taxation, guys, right? Control over ownership carry no taxation. But here's what I believe in, right? If you're actually willing to kind of like give up ownership while you actually maintain maximum control or have that degrees of control, you can actually, I discover over the year is that you can actually control or have more wealth, right? Or control more wealth purely because the significance of your taxes, like, look at land tax and even income tax and capital gain tax or indirect and direct tax, portions of that is not going to be lost in the taxation. So what it means is that, you have a lot more money to control, a lot more equity in the future. So if you actually pay minimal tax, what it means is that you actually got ability to control more tax, right? So this is what I kind of like demystify about control and ownership right now. So for example, if you own a property and get sued, well, guess what? You lost everything. But if you have a property in a trust, properly set up, you get sued, well, you lose whatever you actually have in your personal name because you're the one caused the problem or damages, right? But the asset that you have in a trust, it doesn't own by you. You control it, okay? And so we're going to share with you the actual benefits of having a trust. By the way, before we dive into the actual secret. So that's number one, secret number one. Does everyone get that? Are you following in the first try? Do you get that, Joe?
I mean, it sounds quite an American concept to me. So I'd need to hear how it applies in the Australian context.
So what sounds American?
Well, it's Robert Kiyosaki, of course, so he's American. So I want to understand.
No, that's a concept. It's not American. Controlling something over owning something is not an American
that's
concept.
That's what one thing, if you ask me, what did I discover over the years of practice, public practice, and earlier on you mentioned about how do some of the sophisticated investors will pick me for an example, right? Or some of our clients, or in fact, most of our clients structure the ownership around the property development, renovations, and long-term retirement planning, right? But what I want to do, I want to make sure that we don't miss this, because this is critically important for me to summarize. In fact, you're talking about, well, there you go. Gee, I even put down Aussie, right? There you go. So this is as Aussie as you get, buddy, right? So here's the 5 reasons, or the 5 key why Aussie love trust, right? And so again, I'm going to summarize really quick, because I really just want to get into the example on that. And I think we're going to be we will be on a home stretch after I touch on just a little bit on the SMSF, and then we'll be on that part. Now, so as I said, one of the reason why Aussie actually love trust is privacy. Now, I think as I said, mentioned to you earlier, I mentioned again, is that we Aussie sometimes like to show off a lot as well, or we wanna basically tell people what we own. But when you're having a property in a company trust structure, one of the things that trust actually gives you in terms of one of the benefit is privacy, right? What it means is the legal ownership of a trust asset is actually the trustees, right? So who is actually looking after the trust asset for the benefit of the beneficiary, which in a minute you'll see that, is that, nobody can actually know exactly who are the beneficiary, because I can't see who actually the beneficiary right at the bottom of it, right? Who really control trust, because you got the appointor in the trust documentation. It's not a public document. No one actually see that. So if you actually use a company, earlier on I mentioned, put a company on top of the trust, what you got is what we call a corporate beneficiary, right? A company. So it basically protecting you, having someone actually look down who actually control the trust. So if you use an individual, right, as a like beneficiary members, as an individual trustees for a trust, then when people search the property, they can see straight away Jeff and Joe on the property. But if you use ABC Pty Ltd, nobody actually know that, particularly if you don't even use yourself as a corporate as a director, right? So that's number one.
Good. It hides you. It hides you from anyone that wants to go after you. Okay, that makes sense.
Well, basically, look, you're not doing it in such a way to avoid your liability, but it just makes it a lot harder for anyone trying to search to see who actually control the trust. That's what it is. Like, you're not trying to avoid and run away, the asset that you own and hide it, right? But essentially, just make it a lot more harder for anyone to go deeper into. If anyone wants to do it, they'll find it. They find the best solicitor to do a search, and they'll find out anyway, right? By a search. Now, the second, just a quick one, the second one is really asset protection, which is something that as a practitioner and a specialist, we really focus on the asset protection, the estate planning, the legacy planning, how you can actually transfer your asset to the next generation. So one of the key that I know the rich folks and some of their wealthy clients that we represent, that we have honor to work with, is that they really value protecting the asset, probably more so beyond controlling through the grave, right? And planning for the next succession, for the next generation. So when you have asset protection, this is actually what I've learned for many, many years in practice, is that wealthy people, particularly investors, they use company trust structure to kind of like shield and protect the assets from, creditors and future sort of, I don't know, like gold diggers or something, right? That's another American term, is that right? So the main thing is that, look, what you want to do is, I think you just want to make sure that you work damn hard all your life for all the money that you make, and you have it in your name. And if you get something wrong, you get sued, the money's gone, right? Because it's available for creditor to take it away from you, right? Now, but you have the money, the pot of gold and the money bags in your trust bank account, not trust account, trust bank account, right? Instead of in your name, well, the money is actually locked away, right? in a trust structure. So the trust is really good to protect assets from a bankruptcy, and trust provides you the firewall, right, separating between asset that owns in you by you, so that if you ever get sued, the creditor or potential co-suitor can come in. Now, as I said, really quick one, the less compliance is that trust is different to company, because companies, you got to report to the regulator like ASIC, whereas trust, you don't have to do that, meaning just a little bit less of paperwork, right? But I think the biggest one, guys, if anything at all, the listener take away, in a minute, we jump straight into the example, is the flexibility and tax planning, which is what we do literally every year, all year round and every month. So flexibility just means that in a minute, you see the example, when you actually earn in rental income or share in dividend, and you got flexibility to distribute to mom and dad. If mom is working, you distribute to dad. That's what flexibility means, right? If dad is working, then you distribute to mom. You know what I mean? Now, in the future, if you then, like myself, got 3 kids and I wait until they turn 18, and so if I do sell a property and I get a huge capital gain, if it's in my name and Peter's name, we have to pay tax and declare them in our personal name. But if it's in a company trust name, I have the flexibility to stream the capital gain to my kids and my wife, and as I said, over 18. But here's the best one, right? Let's say my mom happened to go through a GFC or sell a property many years ago that's got losses. Remember I said to you, my parent actually got into trouble and almost lost everything, right? So let's say they sold the property, they have a carry forward losses of capital losses. So here's the beauty. I can distribute the capital gain to offset my mom's capital losses that she had maybe 10 years ago. Right?
Okay, this is where it's now starting to get interesting. Okay.
We're going to go into the picture now. So this is what I want to do. Now, before we jump into that, guys, let's just I'm jumping around a little bit now because we are super excited, right? Now, but here's the thing. So the basic structuring of the rule for structuring is that you always buy in the right structure
got that
from the beginning. Now, asset protection is a good stuff, but you got to do it before you get sued, just like having insurance, right? And if anything that you take away and the audience take away today is that trust are your friends. Okay, all right. Here's a good one. You like a quote, Jeff? Here's a good one. What can you read the red one for me, please, Jeff? While I take a drink.
I saw. Yeah. So always buy your investments in the right entity from the start is what. No,
just the red part. What does the red part say? Can you read it for me, please?
I kind of want Joe to read it because Joe actually
always tell your wife you love her before someone else does, Jeff. That's what you have to do. I don't know what that has to do with trust. Maybe it's a different form of trust. Maybe the normal way of trust. What are we talking about here, Tony?
Well, you always got a structure, have a property. You always have a property, have a trust and buy a property in a trust before you get sued, mate. Right? All right.
Yes.
This is just I just make it up, right? Well, you asked me to make my tax fun, right? Well, this is what I think, right? Now, always tell your wife that you love her before somebody does, Joe, right?
Yes.
I know. So,
okay.
So what does it make sense? So one of the things that I want to talk about, the example.
Hang on, what was the purpose of that? I missed the point of that.
We're gonna before I get into trouble myself, Joe. Let's talk about tax again.
Yeah. Okay.
So in Australia, as you know, if you own an income in your personal name, you get taxed up to 45% plus levy, right? But in a company, you actually got a flat tax rate, particularly going forward from 2022 onward, right? And if you're in super, in a minute, if we got time, we'll touch on really quick. Tax on super before you retire in an accumulation phase is 15% on earning and contribution. But tax on pension, if you get 60 or 65, everything's taxed at 0, which is the numbers that everybody's looking for, right? But here's the thing: we can actually achieve that even before you actually retire as well. So one of the things that what we're going to look at an example is this here, and the real example we mentioned about. So as an we have unpacked company trust, and we talk about the 5 benefits why Aussie loves trust. Yeah, asset protection is one of them. Flexibility and tax planning, which we kind of like didn't demystify, but I'm going to explain to you how flexibility and tax planning kicks in. So we're going to talk about really quick an example. Now it could be one of my example, and it could be one of my client example. And we're going to talk about problems. So problem, remember I said to you earlier, one of the frustration if they've got a wrong structure, if it's in your name, or if you get the wrong advice, you get the wrong tax advice, you're going to be paying a lot of tax, right? Or you're going to get audited. But there's a solution. So we're going to share with you what are some of the smart solution or smart structuring solution, and what are some of the outcome that you can actually achieve out of these little real life examples. So
there's so many great questions coming through as well. I think we're going to have like a 4-hour Q&A here. It's a little.
I might have to get Peter to go out and get a couple of bottles of beer or something, right? But no, let me just share with you some real life example, and then you guys can do the Q&A, and we can go backward again with some of these slides with an example. Now, these are real life example. So this is actually one of our not recent property acquisition, probably about, I dare to say, just over 6 months now. So we bought that property in a place called Urunpilly in Brisbane, 1:3. I was actually talking to Belinda Smith, a good friend, and I was just sort of asking her an opportunity whether I should actually renovate that property, gutting it down, or renovate 3 brand new property. And she says, well, that's not really renovation, that's a built new, right? But anyway, so I bought this property, got a DA for 3 of them, and my intention actually to subdivide and sell originally, right? And it might $a few $100,000, gets in and out. You can see, got a good team of big planning in place, got a good team around me, got a bit of strategy in place, either buy and subdivide and sell, or buy and build and sell. So this is like the plan just came through now, and just actually received a couple of facades. It looks going to look like that, and the plan it starts to look like really an amazing property, whereby I'm thinking I might change my strategy. I don't want to even sell it now. I mean, my missus look at the plan. She go, maybe we move in and live in one because it's so close to Brisbane, right? But here's the numbers, right? Or here's the strategy without going through the numbers. So as I said to you, our strategy is about making money and keeping what we make is what we need to keep, rather than what we got left over. So what we going with this strategy is a company on top of the trust as a legal ownership for the actual property. And this one, he actually got borrowing in place. So that's the reason why I use a company trust. But here's the thing. I set this up purely because, number one, remember one of the great Aussie reasons that they like company trust structure is that we want asset protection, because that's lists very high on my agenda, and tax planning and flexibility. And we're going to use a real life example on how flexible and what really tax planning is able to provide you in helping you minimize your tax as well and keep more of what you make, right? So this is my structure. But no, as an example,
what LVR you said you got borrowing. What LVR did you get on this one, Pete? Or Pete, Tony,
this one is probably 70%.
Oh yeah.
And you can see I actually got a JV partner and joint venture management in place and all that. Yeah. And so nice. So now, just as an example, I'll come back to this. This is another example of actually one of, I think, Belinda Smith's amazing client, right? Where she would basically buy this property with renovation. So again, we put it through a company trust structure, and there is a bit of a JV partners or managers there doing, helping out, putting the deal together and getting the deal up and running. As I said, the what you can achieve by having this structure is, you can protect your asset and get your flexibility that you're looking for, and also easier finance and better control, which is what really property investors and renovators are looking for, that flexibility. Now, so this is how it looks flexible, right? Watch this. And then this is something that we're gonna cover, how do you actually use a family trust and super as a combo, right? This is a little tip for you guys and the audience. This is a slide.
Okay, here we go. You go. No, this is this is what. Please walk through this, because this is a lot.
I think it's needs to be 2 or 3 slides. I'm just what
do we got here?
This is a slide that I made it. I supposed to make it a little bit simple, but it goes a little bit more confusing now. You know what I mean? But this okay. So this is a situation where, let's say, if you looking at from a perspective that if you actually see this example here, this individual buy a property, renovate it, and made a profit of $200,000. You see that $235,000?
Yep. So we've got a family here of a mum, a dad, an 18-year-old son, a 16-year-old son, and dad's sister. We've done a development. We have a property under purchase.
Just for the disclaimer, I just put that dad, sister, so that we don't get the audience confused that it's a dad's girlfriend or mistress. Okay.
Oh, geez.
Yeah, just to clear that up. just to clear that up. However, it does sound like a better tax planning strategy. No. But okay, so we've we've done a deal, we've done a development deal like your just deal above, and we purchased it under a property development company, PTY Ltd, as a corporate trustee, and it was having a property, as a trust attached to it, and now we've made $235,000. If we did this under our individual, we would have to pay tax at the marginal tax rate as an individual. So that $235,000 would be taxed at your marginal tax rate of 45%. So that is where it's like, oh gosh, that's a lot of money. But what you're saying is, no, you can distribute those funds through a trust that allows you to get a better tax break.
Yeah,
is that what you're saying?
Yeah. So as I said, if you buy this property without tax planning, right, and if you buy it either in your name, Jeff, or if you buy it in a company trust name without proper tax planning, if you make $235,000, you'll pay a maximum tax about $100,000, just for argument's sake. Yeah.
Yeah.
So that's the problem. Is that right? Do you see a problem?
Yes, a lot of money.
Yeah, you lose half of it, right? All right.
Yeah.
So what we're saying is, when you're trying to understand, remember I said to you, the key to use a family trust and even with superannuation together, right, is that you're aiming for a tax saving, right? And the tax saving is phenomenal, guys, right? So what you want to do is that you want to really just sort of just have a look at this example in a minute. As I said, the where I shared with you earlier on is that our passion is about really helping client to protect the asset, save tax, but also maximize the return. So watch this, right? So let's say we have a tax planning session and we say, well, okay, you have a mom, you got a dad, and you got an 18-year-old already, you got a 16-year-old, and yep, you can't receive distribution, and you got a dead sister, right? And so you say, okay, look, let's assume mom and dad and sister, they don't work. The 18-year-old don't work at all, for argument's sake, but the 16-year-old is going to be working for the property renovation company, and he's going to get taxed. He's going to get paid $37,000. So that's how we get around distribution to a minor, where you can actually work legally, just like you work for McDonald's, and you get paid. Okay, so that's number one. Number two,
hang on.
Sort of, there's some people that are putting some questions around with Section 10 and all that. And I want to ask not the tough. Yeah, it is a bit of a tough question. What sort of evidence do you have to provide to prove that, or is? So it's
easy. So we'll talk about this shortly. So I think the questions are surrounding about Section 100A, which is a fairly new section kicking in 1st of July. We'll talk about that. Again, it's something.
You can still not circumnavigate, but you can still. I mean, you can genuinely show that there's evidence of that. So yeah.
Well, yeah, it's a new rule. You got to understand it, and you just got to make sure you use it. You use it to comply with the law. That's all, right?
So what you're saying, Tony, is you can't distribute cash to a minor, but if you're doing a development project, that 16-year-old, not minor, the 16-year-old can work for your company, and you're able to pay them cash money instead of distributing it. Paying them wages.
So that's number one. Now, number two, we're saying that okay, mom and dad and the sister,
that's my golden nugget.
they don't work. So we have in fact, you're saying, oh, Tony, how some of your rich folks client doing, or some of how your successful developer doing? Well, the reason why they do developments, they don't want to work for anybody. They want financial freedom. They want freedoms of choice. Like you and me, we don't have a JOB. We don't have PAYG, right? We work because we love to work, right? Got the flexibility. So, I then say, okay, I'll pay $37,000 to dad and $37,000 to mom. Right, because they're obviously doing all this deal themselves, but they don't take wages
as employees from the company. The property
distribution. So as I say,
they're partners in the company or in the trust.
Yeah, you can actually pay them wages, or you give them distribution. Either way, it's very very flexible, right? Now, and so if you got an 18-year-old, like I got an 18-year-old lady, and she doesn't work for argument, which she did, but let's assume she doesn't, I can distribute $37,000 for it. Don't forget, if you don't work, your tax-free threshold up to $18,200 is actually tax-free. Even in fact, with a rebate, you can actually earn up to $22,000, just under 23, right? So imagine you distribute, $18,000 or $37,000 18-year-old. You can see I'm so excited because I'm trying to get to the drum roll, right? This is a real life case study, by the way. Now, and then You then say, oh, by the way, my sisters don't work. And we do have clients that actually have sister and they want to bless the sister. Section 100A as well. You make sure you distribute the money to your sister, right? And here's the thing: you say, well, gee, I thought you might be able to pay myself superannuation. Pay myself super. So maximum super this year is 10.5%. Well, you can actually distribute up to 27,500. But let's say you decided to, contribute 25 to yourself and 25 to mom and dad each. So that's 50,000, right? Each. Now, so the 50,000 each will be taxed at 15%. So that's $7,500. And the $37,000. Now, for the sake of the exercise, I kind of demonstrate it in a simplicity form, but you can see how much tax you're saving, almost $81,000, guy. See that? So if you go $37,000 to a 5 individual member, and then tax on that is $3,000, and then 50,000 to super, that's tax on that is only 15%, which is $7,000. So all up, you're paying $24,000 instead of $100,000.
You got a question there, Joe. I saw it. You're thinking away, or were you just looking to summarize it?
So look, I mean, if you look at the effective tax, that's about 10.37% or 10% here and there. So look, this whole thing, guys, is really about using an example to demonstrate the power of flexibility, right? So what it means is that if suddenly, your dad might call up and he's got a high pay income job, he decided to go back to work because he got an offer. So we don't distribute 37,000 to him. We might distribute to the bucket company or to the missus, right? If mom suddenly wanted to start a business and she suddenly earn a lot of money and she doesn't wish to get distributed of $37,000, or if the 16-year-old doesn't want to work for you, well, that's fine. We'll distribute it to a bucket company, which is another example. Now, hold your horses and question. I'll use another example, and then you can come back.
With
a question. Now, if you this is another example, real life example, guys. Right? I protected his innocent. Let's call him Simon. Right? Now, his name is John, by the way. Right? Call him Simon. Right? So he gave me the right. He said, "Look,
let's protect his identity."
Well, there's plenty of Johns around. So
But he bought this property, Brisbane, very close to CBD, Terragindi, I think, 700 grand. Obviously, 12, 15 months ago, before property go crazy. Same property in that area now, like 1.2, 1.3 million. Now, built cost now about 1.2, 1.5, costing 500 grand. I've got a bit of a coin in this here, by the way. And then, and look, the guys sell it and they're really, really, in fact, I was like so surprised. I mean, Farringham, the guys actually make a lot more money in one year than what he make in 10 years,
3
right?
years.
Yeah. So let's assume you buy the property, 700-800 grand, build them 700-800. This is what I call a knockdown, right? New word for us, knockdown. So they basically buy it, build it and flip it, and made about 800 grand profit. So this is how we treat the profit. See that? All right. Again, we bought this property through a company trust structure. Again, with a company on top of the trust as acting as a trustees. I give you the asset protection and the limited liability. So when we make that profit, the profit get taxed at 25%, which is 225 grand. Right?
This is great. Can I ask a question though about how you found that property and how you were confident to pull the trigger? Because that's we're talking just as the pandemic was sort of, I mean, it was there, but yeah, December.
It's amazing, right? This is why we work as a team, right? So this is why we like Joe, and we work with people like Belinda Smith and all, like training client to be a good property renovator. Joe, he's got a pleasure of presenting with me and Belinda. That's an amazing experience. By the way, my hat's off you, mate. You've done a really, really well done job. And look, you got to surround yourself with, instead of you doing all the work, then you appoint a professional people who like Joe all day long. That's all he does, looking for a deal. Right.
I'll look for a deal or two as well, Tony. But
yeah. And so look, so the buyer's agent will find the deal, right? And obviously you put a deal together and either use some of your coin in terms of deposits and make sure that, as I said, this individual earn good money so they can actually borrow. There's not much partners there, so we put part of the strategy. You put some money to super to maximize it, but because these individuals only are very young, under 30, and they want these money not locked away, and they want to redo another project again. So what we do is that we park the money in the bucket company. So instead of in a corporate beneficiary, which doesn't trade, it's just acting like a manager, we put it into a bucket company. So the bucket company, beauty of a bucket company is that, remember I said to you, one of the negative or in fact disadvantages of a trust, unlike company, is that company you can retain the profit and get taxed at 25%, whereas trust you actually have to distribute it out at the end of 30th of June. You can't keep it there. So similar to the example number one, the client's a lot more mature, right? And they got kids and the husband and wife are not working, right? So they're more mature. They're in a little bit more comfort zone in terms of financial status. So they can distribute the from a tax planning point of view, we can distribute the profit from a trust profit to individual. But in this instance, this is a young fella, just got married, got no kids, no distribution to any what we call a low individual tax bracket, right? Members. So we'd have to distribute. We create what we call a bucket company, or sometimes people might call it corporate beneficiary. So the beauty about corporate beneficiary, you get taxed at 25%, and you can actually now trap the profit in the company, right? And you pay 25%. Let's say $1 million, you pay 25% tax, which is 250 grand. That's 250 grand, guys. It's different to someone earns $1 million, pay a PAYG. Imagine you work as a CEO in a multinational company, earn $1 million, you pay a PAYG of almost, let's say if you're free tax advisor, you pay 25% tax. Well, that tax is gone forever, right? By the way, if you earn $1 million as a PAYG, you're gonna pay at least 50% tax anyway, right? But that tax is gone forever. It's a dumb tax. You never get it back. Whereas when you pay it to a bucket company, it gets better, right? You get taxed like.
So, Joe, do you have a question? I see, Joe. I mean, I'm following pretty. If anybody's not following, let us know. But I mean, it's just a different way of thinking.
Yeah.
Well, that's all it is. So yeah, my question is, what you're saying here is, when you get a corporate trustee, you don't. What if you don't want to distribute this company? What if you don't want to distribute these profits to the individual or to the property? It's if you want to keep going. So the money flows through that let's just say $100,000 profit flows through the corporate trustee, goes through the trust, and then is distributed not to you as an individual who's earning $100,000 as your normal salary. It goes to the bucket company, where it has paid tax at the top of 25%. So you've paid $25,000 of tax according to the ATO, and you're getting your franking dividend tax credit back. So back to you, and then that drops into the bucket company that catches the $75,000 and the $25,000 franking credit. So you've then got $100,000 in profit sat there ready to do whatever you want to be able to then go and do another one? Or are you charged 25% and then it's $75,000 that lands in that bucket at the bottom?
Yeah, so almost right, Joe. Look, so that it doesn't contravene or turn it into an advice. This is an example. What we're saying is that if you make $1 million, right? So you do a property development, a company as trustee for a trust. You make $1 million. Number one rule is a trust cannot keep the profit, right? Retained to the 30th of June. So it must go. So as a first example, we then say we distribute it to the individual, because this particular individual client has got a lot of individual member that doesn't earn any income during the financial year. Also got a adult over 18 students or kids, and also got a kids that actually want to work in a property development company. Right now, this particular individual is actually a single husband and wife. They both earn high six figures income, right? Yep. And they got plenty of time to love property.
What you're saying is, I earn $100,000. My wife earn $100,000. We don't want the money. We don't need the money right now, but we want to do another development.
You just drop it into a bucket company, not corporate beneficiary, a bucket company. And so you treat, and then you tax the whole $1 million in a company. Right, so under the new section, in terms of what Section 100A, what in the past people don't usually distribute the $1 million into bucket company. So with the new section, what the ATO want to see is that you don't sort of not distribute the $1 million into a bucket company without actually distributing the money. right? So what you want to do in this
So
instance,
eventually has to go somewhere, right? Is that what I'm sort of?
So what a lot of you mentioned earlier on, what a lot of the property investors do is that they drop it to a bucket company. They treat it like a bank, like an investment bank. They treat it literally as your own bank, right? Because you made $1 million, 25% go to ATO as a franking credit sitting there ready for you to coming back, but 75% being 750 grand is or 675,000 sits in your corporate beneficiary, a bucket company bank account. Now, what do you
a question that somebody's asked, and I think it's worthwhile bringing up is I think I understand this question from this person, from Luke. He said, "Can the money be accessed easily?" I mean, define easily though. Like, is it? It's not like you can't go to the ATM and take out the money. Like, or can you? Like,
well, you can, but if you do, you got a problem, right? Well, it's a small problem. It's called Division 7A. If you just go access it by yourself, girlfriend a nice LV bag or diamond ring, well, you can do whatever you want. It's your money, right? But if you don't treat it correctly, where you declare as a dividend, you just take the money. Then, according to the law, you just basically loan yourself money. And if you don't put in place a proper, compliance loan agreements or dividend, you're going to have what I call a Division 7A issue, right? So ATO is going to treat that. If you don't address them before 30th of June, the ATO is going to treat the money you just took out as a taxable income. In fact, it's pretty bad.
So it sounds like you can leverage the profits from that bucket company to
so in this instance, what we're saying is this, Jeff, is that if you put in place a proper compliance agreement, the basically bucket company is just acting as another bank, right? Which is your own personal bank. You then lend the money to another entity, a new entity, to buy another property, to do another deal. And only this time, you don't have to borrow so much anymore because you got the net profit.
Become your own bank. That's what the ultra wealthy really do. I mean, that's what they a lot talk about. Yeah, becoming your own bank.
Become your own bank. Yeah, absolutely. Yeah. So now I think we just hit what? How much time we got? Do you want to maybe queue for a stop here for Q&A, or there's a few more slides that you might want to talk about? Oh, so as I said, the amazing power
round two, Tony. I don't know what we after review.
I don't know. Let's just can we cover off this bucket company stuff, because I'm interested in what this is about, because it's not something that you hear too much about. So rental income, profits, shares, interest, trust distributions, after expenses, they all go into the bucket company.
Let's make sure.
So here's the beauty, right? So the bucket company, the beauty about this trust, amazing of a trust, is that you can distribute to the bucket company. Okay, so once the money goes to a bucket company, in the future, let's say when your kid's grown up, or when you and your wife don't work anymore and you got a very low income, right? You could actually distribute income and capital gain to a working husband in terms of a capital gain if he does got a capital losses, or to a non-working wife that actually don't have any income to declare. So we can distribute some dividends or rental income to the wife and managing the tax that way. Or as I say, you can distribute to your parent as long as they're not on Centrelink, or to your other relative member if you so choose. So this is just a quick demonstrations on the amazing power of having a trust when you distribute profit to a bucket company, and you can distribute back out again.
Have you got another slide on the bucket company?
Do you want an example, Joe?
Well, so what do you do once you've got this $225,000 from you've got your $1 million and you've paid your 25% tax? You can then just use that company to loan it to the original company and do another deal, and then do the exact same thing, and then that money then falls through that company into another bucket company, which catches
into another
even more
trust structure. Into a company that you want to, if you decide to use a company, or into a company trust structure to buy another property.
Yep. And it just catches it to allow you to go again.
I think the potentially powerful thing, correct me wrong here, Tony, is you wouldn't necessarily, I mean, it all depends on the type of deal. You wouldn't have to necessarily sell if you decide that you don't want to necessarily sell the asset, you want to retain it, you want to get rental income from it. Does that complicate things too much, or is that possible?
Yeah, so if you've got a strategy, like I said, if you decide not to sell it, you keep it, right? And your structure is still pretty good because it's in a trust structure. Obviously, you probably have to return all the GST back if you decide to claim the GST. If you keep it long term, then ultimately become an investment, right? You hold it as long as possible. You sell it, it becomes a capital gain. So you sell it. Here's a good part with a trust structure, different to the company. Trust can still access to the 50% amazing CGT discount.
With the flexibility to, depending on the members of the trustee or the trust company, or
the trust, yeah. So probably, I think in terms of maybe one of the biggest takeaway is for the audience is that trusts are good to save you tax, right? So that's pretty much all it is, right? It gives you the flexibility, right? It gives you the asset protection. Now,
should have said that at the start.
Yeah. Well, I'm telling you,
it's an hour and a half.
You got to wait to the now. The company are good because they protect your assets, right? So that's really what trust and companies are for, right? A trust gives you the flexibility, right? Because it saves you tax, right? Companies are good; it gives you the limited liability and asset protections, right? But if you use it correctly, it's an amazing tool. That's like how you guys are sharing in the Facebook, right? For us as an accountant, we use company and trust just like a tool, no different than carpenters using a hammer and a drill, right? If you use it wrongly, you're going to produce a crap, cabinetry, right? Same as a trust. You think you can set it up yourself. You think you can just get an average Joe bloke, run-of-the-mill accountant to run it for you or provide you advice. That's okay, but you just don't know what you don't know, right? But what I'm sharing with you is, my takeaway.
Change that to John Blow for the sake of poor Joe. He gets.
Yeah, no, but it's true. I was chatting to an accountant. I was chatting to. I got a trust set up, and I was chatting to you, Tony, and there was I don't remember what the situation was, so I wish I could. But there was the thing is like, if this thing wasn't assigned to the right person, if you had somebody, you can mess it up essentially, and you have to fully redo it again. But I'm interested to jump into some of the questions about things that people have, because we have a whole.
While Joe's picking a question, throw your question in. I want to. Everybody's probably not everybody. Probably a lot of people are thinking, okay, great, we'll just talk through this. Brilliant. It's like it's the best thing since sliced bread. How much does it cost? That's what I'm like the maintenance, and so I'm just thinking question. if I'm doing a small 400 to 600K development. Is the juice worth the squeeze to be able to settle this, or does it have to be a bit more kind of meaty profits?
Let me just show you this example, guys. See, now this example here, if you buy a rental, now this is a serious rental, right? So that's why they make 200 grand profit, right? See this here, that's a serious rental, so they make 200 grand profit. See that? This is a serious property, what we call a flipper, right? Or a knockdown, right? So he's not a monkey businessman, right? Now, if you're making $1 million profit, or if you're making 200 grand profit here, right? So cost of setting it up might be a couple of grand coins. It costs you a couple of grand, right? Yep. Cost of running, if you're just holding it, might be anything between 1,500 to 2.5 grand, right? So you do the sum yourself. Now, if you develop it, take you 1 or 2 years, that's the end of it, right? Might be cost you a couple of grand plus advisory, just to get it right, And it really depends on who's doing all the bookworks and whether or not you're also constantly seeking advice as well, right? So it costs you a couple of grand to set up, maybe a couple of grand to run, either buy and hold or buy and develop. You just do the sum. Now, if you're saving $80,000 in tax, and you work out your sum, is it worth it or not? Is it worth the squeeze? Jeff, what do you think?
I just because it's a common objection that a lot of people, and even Joe and I talk about this sometimes, like, oh, but it's going to cost money. I'm like, well, yeah, if you're making, how much is it going to save? I mean, and that's but no, I think it's a question that a lot of people think about, and they don't think about how much they can save. They think about how much they're losing by paying for it. But let's get into some questions, Joe.
Exactly. Well, that's one of the things, right? Tax is one of those things that. Here we go. Yeah, break even 5K approximately. If you can save that, then it makes sense. Carpenters are probably running
a business through a trust.
Okay, so one question that I've got, Jeff, you're better at searching for these bloody comments than I am, is around Tony buying and holding these properties. We've talked about renovation and flip, full subdivision development and flip. We're distributing income to us. But now, what if we just decide to buy and hold?
There you go. Do you see that? That's a master plan. I paid a lot of money for these 20 years ago. I still got the receipts and a check copy and all the ODs that I set up with a big law firm. So if you buy and hold, you see the first number one, it says B company. So after my book that I've learned, right? Yep. So this is the first trust that I set up to buy a property at 8 Mile Plain. All right, probably about just under 500 grand under a company trust structure. Mm-hmm. So that's probably about 15 years ago. Right?
Yep.
So as you can see, I don't get negative gearing, but what I do get is losses, don't you? Because you got depreciation, and if you highly gear it, you got almost like negative cash flow and negative gearing, wouldn't it? So you got losses. It's called losses. Whereas if it's in your personal name, you can offset the your own personal tax deduction.
Yep. So that's really the bad thing. Having that tax loss held into a company is not a good thing. I don't want that.
Yeah.
I want to be able to
So I don't want to do negative gearing. As I say, my intention is not to negative gear because I know I'm going to be buying more property and I've got a plan, and I'm also going to become the high risk individual, right? So which means I need to make sure I control all my assets and not having any assets in my personal name. Because if I want negative gearing, I probably have to, without opting to have a special trust, I need to have it in my personal name, right? So that's one way of me having a property in a company trust structure. Here's the thing, right? 15, 17 years later, guess how much that property was? Give you a little bit idea.
1.25.
It's just going up. I couldn't believe it. I wish I did a valuation. Never done a valuation in my life in that property. It's like buy and forget. Because as I said, you go with the intention and a plan and a strategy, right? Here's the thing. We're not going to touch on too much land tax tonight. 10, 15 years ago, we got no land tax because the property we bought it is 500. The land is not even worth 500. Just now, the land alone is like 50. You know what I mean? Yeah. Right? So I put in a company trust. So I've got a lot of accumulated losses there. So how I offset?
So what have you lost? What have you lost? It's positive.
Well, you lost initially. You got a lot of bit of negative cash flow because the rent coming in is less than the money goes out, right?
Yep.
Yeah. Right. And so a bit of negative gearing. So it's almost like negative cash flow about, I don't know, 5, 10 grand, 15 grand, right?
You got the depreciation
every year. So you've got 5 grand, 5 grand, 5 grand, and you're not claiming that as your own individual tax return.
Depreciation because it's brand new property. Before the new rule kicks in, I got a 15 grand depreciation. So how much is that? That's 30 grand, right?
Yeah.
So 30 grand.
But it swings and roundabouts. So like over the longer term,
exactly.
And you got a depreciation once.
Yeah. So what I'm gonna do is if I got some carry forward losses there, but in the future I plan to buy more property that's got commercial property that's earning positive cash flow, and I do some property development. These are my property, by the way, guys, right? And so I might sell that. I decide not to keep it, right? So if I sell it, I make a profit. So remember I used an example earlier on. If you made a capital gain in a trust, but your wife has got capital losses, or my mum had a capital losses a long time ago.
Yeah.
So that's like my mum. It's got a trust losses, right? That the carry forward losses. So I distribute my income, my trust profit to offset the losses before I even have to distribute to anybody. So that's another way of sharing with you and the audience on the flexibility and the power of the amazing potential benefits and of trust, is that you might not have an immediate benefit, but you definitely got future benefit. You just don't see it. That's a problem with, I think, having a trust, right? It's like an insurance. You buy it now, you be damned if you don't, be damned if you do, and you don't want it. But if you do need it, it's there, right? But if you don't use up, you got to pay another premium. Damn it, I didn't get to use it. Well, you don't want to use it, right? So trust. Sometimes what I've learned, you got to be patient. You got to appreciate
it. People struggle with the who wins the race usually, the tortoise. I'm guilty of it as well.
Okay, yeah. I just want to recap this slide. Is what you're saying is you're losing money and then you make money on another property, and you then they even each other out, and then you don't have to pay any tax because you've lost and then you've made.
Well, you can't claim the deduction, Joe. That's what.
Yeah, you're not losing money. You obviously, the property is costing you money, your money to hold, just like negative gearing, right? But the difference is you don't get the immediate negative gearing tax benefit offset against your income. So the losses are still there, carry forward. So you just carry forward to the next year. So first year,
that makes sense.
So you feel the pain that you don't get a benefit in the first year. It's like having an insurance premium. You never use it, but it costs you money. But it's
this is the funny thing as well. Like
the loss is still there for you, for you to offset. Now, here's the best thing that I found.
Somebody's asked, in that example, are they all under the same trust to distribute the loss? I imagine they would need to be.
Good question.
No, there you go. See, I got ABCD. It's like a banana in pajamas. See, I have a different trust. Now, and then in the next session,
you distribute at the end.
So there's a little secret here. When you do, set up a trust, you obviously set up with a good intention. And a good intention could be, you got to consider the effect of the degrees of asset protections, succession planning, the flexibility you need for your future legacy, and maybe wealth sort of transformation, right? You don't do it for the sake of tax avoidance, because that's illegal. You know what I mean? But this is legally minimize your tax, done it in the right way. So when you actually got losses, see, I feel the pain of having this property in the last probably 10 years that's got losses sitting there, and I'm not using it. But suddenly, if I then suddenly take all the equity away and going to do a property development or buy a commercial property, that's suddenly creating a cash flow positive, right? By the way, by that time, my property become cash flow positive anyway, right? So I've got still losses there. Now, but if I got positive cash flow of another trust, now again, the golden rule is you always want to separate your assets and segregate it. So you really want to use a different company trust, because what you don't want to do is put too many property in the same trust structure, because if anything goes wrong, just like having all the property in your name, the trust owns all the property. If the trust gets sued, then you got all the assets in the same trust. So ideally, is you want.
So that's one of the questions. That was one of the questions that was raised. Do you believe it's better to have separate or different trusts for each and every property for asset protection? Now, what's your kind of general rule of thumb for that? Is it one property for each trust? Or is it 3, 4? I don't know. What do you?
Or does it depend?
Well, I've seen guys buy property 1, 2, 3, 4, 5, 6, 7, 8. Heck, they don't care about land tax, but now they do, right? With a new Queensland land tax rule kicks in. So the ideally is that if you really big on asset protection, you definitely want to separate. Again, it really depends on the value of the property. When I started, properties are selling around 50, 100 grand, right? So you could put 10 property, in one trust, because there's no benefits of having too many trusts. But here's the thing: 20 years later, that 100 grand property like mine is going to be $1 million or 500 grand. Now you've got a problem because the value is too high. And if you do transfer now, you're going to cop with a big, massive stamp duty and capital gain. But here's the best, right? If you put too many property under one trust in Queensland, each trust is actually only able to access to a $350,000 land tax threshold. So it was good for 10 years ago, but it's not good now. So that's why
and that's the interesting thing going forward as well. It looks like potentially that the other states are going to jump on the same kind of bandwagon as well. So maybe thinking, because if people had all their properties in one trust, they're going to get whacked with stamp duty. But if people that distributed them between multiple, they're not going to suffer as hard as someone that has. Anyway, let's jump off onto the screen with our faces, and it jumps up all the comments.
How do I do that?
Yeah, I've got the comments here. Can existing? This is I don't question.
Yeah. How do we jump off the screen, guys?
Well, I'll just remove it. No, actually, I can't. I'll kick you. Just click onto the Facebook. A question that's come up here: can existing properties be moved into a trust structure later? How easy or complex is this? So let's just say they bought it in their individual name. They're looking to get it under a trust. Now, can they do it?
Probably
the answer is you can do whatever. Yeah, the answer is you can do whatever you like, but obviously first you got to consult your own accountants or professional trusted advisor. But I would just be aware. Peter, can you just switch off the PPT? You just got to be really cautious about when you actually make changes to your ownership structure in the future. Now you just got to consider the actual additional costs that might basically affect the actual transactions in terms of the transfer. So things like setting up the trust structures, considering the actual transfer duty, because you're trying to transfer it because of a land tax. Now, if you do that, you got to be careful about the anti-avoidance provision as well, right? You don't do it because you're trying to minimize your tax and avoid paying land tax. But you also got to think about the capital gain. Like in my case, if I buy the property $100,000, I'm selling it, say, $1 million now. That's a $900,000 capital gain. 50% of that, I'm gonna get hit, right? You know what I mean? Yeah. So these are things that you need to consider. Okay.
Yeah.
It's a great question. As long as you can hear us, Tony, it doesn't really matter too much. We can see you; it's fine.
Yeah, okay. It's all good. As long we may need to sort of you can talk generally, I suppose, about this, but one of the questions that a couple of people have asked is how do you borrow money? I mean, obviously, I think it's more if we expand out and say what is the process? How difficult is it to borrow when you're looking for a trust in your experience?
Yeah, look, I think borrowing money in a trust is very easy because I got used to it. I know the right. I think best is talk to a financial broker. Yeah, someone that's specializing in trust structures borrowing. Right. Look, it's not difficult, Jeff, because trust been around for a long time. There's a lot of good people out there understand trust now anyway. So if you just deal with a right mortgage broker, I'm sure they understand that you using a trust to buy a property. They'll find the right lender to help you guys to get your finance. You know what I mean? It's much the same. Look, it is a little bit more complicated, more compliance. You ultimately got to basically look at individual courses. Like some people might borrow through a trust that's actually got able to borrow a lot more in terms of LVR, being 80, 90, 100%. Yeah. Some people might not be able to borrow it because of the serviceability. Look, trust sometimes bank generally might only lend up to 80% for argument's sake for a residential property, buy and hold, not so much as property development, commercial. But if you're professional doctors and high income earner, the bank will lend you money.
Yeah, it's interesting because I thought that with trust structures, the max would be 80%. But recently chatting to Aaron, a guy we had on live, who's also a broker, he mentioned that it is possible in trust to go above 80% LVR, of course, in the right circumstances. So,
and I think...
Sorry, Joe.
Yeah. The most important thing, I think, is having all of your team members across what you're doing so that they can best help you and create a structure around that. I've heard of investors, sophisticated property investors, paying their accountant and paying their mortgage broker and paying everyone, as they already are, to be in the same room and say, hey, you need to figure out the structure and the property that we need to buy. Not that you need to pay these, you don't necessarily need to pay them to do it, but they all need to be across exactly what you're doing so they can go out and help you. I'm starting to see this be so much more important when it comes from a structuring side of things, from a lending and from a property, and also the ability to buy a property at the numbers that people want. Like a lot of mortgage brokers are going to lean more to cash flow. They're going to say, I want a 6, 7, 8% yield. And then the account's going to be like, well, they're all going to have competing views and ideas. And then it's meeting in the middle. So you can balance it and say, well, we're not going to get a 7% yield. We're going to get more of a 5.5% yield. Does that still allow us to borrow? Does that still give us X? Those type of things are things to think about as well.
Yeah. This is an interesting one. I won't mention the name of this person, but said, are certain trust structures better at protecting assets in divorce? I think it's the latter, isn't it? But...
Yeah, I knew some. Every time I do this, I knew there's some questions coming in. Look, I think best
not legal advice, by the way, people. Not legal advice.
Yeah, look, I think best is don't get divorced, guys. That's probably my best advice. Like I said, trust. Say how much you love your wife before somebody did. I think look, trust is not really there to protect your relationship breakdown. Certainly, you can probably talk to our legal advisors on that. Find a really good one, hopefully before you happen. But look, yeah, so if you're thinking of setting up trust structures for the sake of planning for divorce or not, I think it doesn't work that way.
Yeah. The other thing that, as we were sort of talking about, you said there's limited or liability limited to that thing is, from my understanding, you've still got provided you don't do something negligent. If you do something negligent, then you that is one caveat. So what I mean is about is it the corporate veil concept? Is that?
Yeah, well, as I said, there are corporate law out there protecting, creditors as well, right? Like so-called ATO is one of the biggest creditor as well. If you owe tax office money, they do have a special rule, and one of them being what they call DPN, Director Penalty Notice. So if you run a business and you owe tax and you don't pay tax in a company or trust, and if you don't manage it well, look, at the end of the day, ATO is your creditor, you owe money, you got to pay tax, right? If you don't set up company trust structures to avoid tax and avoid liability, right? So there are law protecting, the operations or the regulations, and one of the law would be a DPN, which is a director penalty notice, is that if you don't pay, just because you set up a company and you're a director, if ATO, which has been one of the actual creditor, issue you a DPN, meaning basically a director penalty notice, what it means is, in a layman term, is that ATO now hold your person responsible for the debt that the company surely incur. So instead of being a corporate debt, it becomes a personal debt, then ATO will go after you. Right? Now, if you obviously got assets in your name, you'll be at risk.
Yeah. Yes, it's great you mentioned that, and I like that you're tempering, like you've got all these kind of tactics, but it's also important that I like the balance there. Good stuff, Tony. I think we've got time for one.
You still got to obey the legislations and do the right thing, and manage your tax affair and meet your tax obligation. Pay your tax, guys. There are legal structures to help you to minimize your tax legally. Why I work with my client is really, for myself and Peter personally, we definitely need to make sure you imagine and you intentionally believe yourself that, you have the assignment, and is like your purpose in life is to do something special, right? Either for your family or maybe for yourself. So you really gonna give yourself the intention, but also the opportunity to make sure you have a future plan, have the right strategy around the portfolio that you're going to build, such as buying property in your personal name and structures, or even SMSF, which we didn't get a chance to touch on too much, but that could be another session and a hot topic that we can do. But definitely when you decide to invest in property, particularly for a long term, and if you're going to engage into a property renovations or property development, you really need to think about the timing of the property investings or holding, right? Being short term and long term. So, and if you get that ticked off, next thing you got to think about is really the right structures of the structure around your property portfolio holding, because getting the right foundation is so critical for your future sort of planning as well. So when you get that going by using the right structure, potentially you could save a lot of tax and a lot of headache, and also you can pass on the hard-earned income, the wealth that you built for your next generation. And looking at a longer term succession planning, like a retirement planning or legacy planning, right? So main thing is that, if you're thinking about minimizing tax, the rule that I surround myself is not to doing it for the sake of illegally minimizing or avoiding it. But if you do it with the right intentions of asset protections, and considering the fact that you do it because it's a long-term asset planning, and you're making sure that you want to protect your family assets that you built. And as I said, the key is not how much you actually make, it's actually how much you get to keep at the end. So you don't want to wind up when you get to 65 and suddenly you do some dumb thing and you get divorced or you get ATO hit you because, either you haven't done the right thing paying your tax, and you're just doesn't matter what structures you set up, you're going to end up losing all your asset, right? So I think important thing is just to, plan with the end in mind and knowing where you are now, where you want to go, what's your objective, what's your ultimate outcome, what's your dream result, okay? And ask yourself one thing, am I gonna be okay? Can I live the life that I want, right? Well, to live a life that you want in the future or now is you're gonna make sure you get to keep what you make, so you can actually look after yourself and take care of your family. Does it make sense? Are you on the same page with me?
Yeah. Absolutely, mate. This has been a absolute cracker of a session. I think you've opened the lid on a lot of what other accountants keep hidden behind a veil of obscurity that make things difficult for us to understand, so that we just hand over the keys and just blah, blah, blah. I don't need to know about this. But this has been one of our most popular sessions ever. We have over 100, 110, 120, 130 people on at any one time. So people are really eager for this knowledge, and it's amazing how much you've shared. So I really appreciate that, Tony. How do people get in contact with you? How do they get in touch because again, like with these new land tax rules, with structuring, it needs to be done right at the beginning so you don't end up repaying stamp duty and doing all of that stuff. So how can people learn more from you?
Have you got your presentation?
Thanks so much for that, John. I'm trying to look for these. As I say, look, how about I just share this little slide for our audience, in fact, for yourself and for ourselves, right? I think between all of us, Jeff, and you and me, really, I think one thing that we set out to do is to make a decision to make a difference in the intention living a good life, right? Second thing is, I never believed that I am where I am today, but if you make an intention and a decision and also give yourself the permission to believe in yourself, right? And next thing you got to do is surround yourself by great supporter, great advisor, great mentor. And it goes a long way in achieving your result, because you got that dynamic support. So certainly, if the audience wants to, work with me as a property investor or developer, or even a small business owner, where you want to get clear strategy, the right sort of property structures, either investing for renovation, development, or holding, or even just, get the right advice so it can help you to go along and make a difference in your life. Look, I put together, I don't know if can you see a bit of just a bit of
See more about us. You can visit our website, Lee and Lee, and you've got an email there for Tony, and you've got
leeandlee.com.au,
Facebook, LinkedIn, and Instagram. You're not on TikTok yet, Tony.
Not yet. Yeah. I'm working on that, right? But anyway, my wife mentioned trying to walk before you crawl, right? Well, before you run. Yeah.
Yeah, it's you're one of the. There's not a lot of There's only probably one or two accountants who are sort of and your way you've explained it, and I love the examples. So I appreciate you putting all the time, effort, and energy to putting the slides together, Tony. And thanks, Joe, for making the intro to get Tony on the show. You have delivered.
Yeah, it's been an absolute banger of a session. It's covered off a whole heap of things about trust, whole heap of things about companies and structuring. It's been absolutely wild, and it's going to make a huge difference to a lot of property investors. So thank you for sharing the goods, Tony. Is there anything else you wanted to say or cover off, mate?
Mate, I'm humble, and I'm actually amazed that you guys are also. Thanks very much again, Jeff. The opportunity to share with your audience, and actually I'm humbled just to share what we have learned. I'm great believers about the concepts of sharing is caring. But look, my probably remark in closing is that as I said, make a decision to be a blesser, to be who you want to become. In saying that is that I hope tonight I've been able to basically share with you and the audience maybe a couple of nuggets. I know I took away a couple of myself. That can actually maybe enhance, but help you and put you in the wealth creation. So for audience that hasn't been started about wealth creation, well, if I can do it, you guys can do it. And just that add a bit of a juice to your personal wealth creation or personal success. So as you leave today, you take away for yourself a bit of, as I said, give yourself the permission and intention to add some wisdom, right? To help you make that wealth creation journey a lot easier. Look, guys, thanks very much again. We're here to help. So if you look out for a great accountant passionate about helping property investors and business owner to minimize tax or protect your assets, might look out for me. Check it out, our website.
Lee and Lee.
I'll look forward to talk to you guys.
Yeah, one thing that we're going to be doing is uploading this thing into YouTube because I need to Yeah, I need to rewatch this thing again myself and learn a little bit more about the bucket company strategy and how you optimize that and how you can offset.
Make sure it's not a leaky bucket, Joe.
It's not definitely not a leaky bucket. Leaky company co PTY LTD. Call it what you want. Awesome. Okay. Well, that is the show. Thank you, everyone.
I want to say thanks to the audience as well. Like, thanks for all the comments and engagement interactions. Like, without the audience, it's not as much fun. It's still damn fun. It will be fun.
Definitely. So go over to YouTube, subscribe, and do all that fun stuff that you do over there, and reach out to Tony. And appreciate it, guys. Amazing value, amazing session. Let's go buy a property. See you later.
Awesome. Okay, amazing. Okay, thanks very much, guys. Have a great night.